Yesterday, a lot of the major US healthcare insurance stocks took a sharp hit, and Centene wasn't spared, as its shares fell nearly 9% to $34 in a single day. And the drop came after Donald Trump proposed redirecting federal healthcare funding directly to individuals rather than through insurance companies. On top of that, he called insurers money-sucking. Now, I personally own Centene, and even after the sell-off, my position is still up over 20% since I first bought 3 months ago. And this is why I'm not panicking just yet. While Trump's proposal is definitely worth following, he hasn't taken any action yet. Right now, this is mostly market noise and uncertainty, and not an immediate threat to Centene's business. So in this video, I'll break down Centene's latest earnings, analyze its financials, and calculate its intrinsic value to show you exactly why, despite the recent market jitters, I still like this stock. Now, if you enjoy these kind of videos, consider dropping a like and subscribe to help grow my channel. And now, onto the video. So Centene just released their third quarter results, and there is a lot to unpack. This is a major healthcare insurance company, mainly in Medicaid and marketplace plans. And in this sector, profit margins are naturally very thin. Even a small increase of just a few percent in costs can wipe out large chunks of profits. And right now, that's exactly what's happening across the entire industry. Earlier this year, a rise in health benefits ratio, which is a share of premiums paid for healthcare, caused Centene to slash earnings guidance from $7 per share to $1.75. And the market reacted drastically, causing the stock price of Centene drop around 40% in a single day. However, their third quarter results bring some positive signs. Centene reported adjusted EPS of 50 cents. Revenue came at $49.69 billion, which is up 18.2% year over year and above analyst estimates by 3.7%. Management also raised their full-year guidance to about $2 per share, which is hinting that the company is starting to recover. While the increase is small, it's still something. Now, as I mentioned before, the key issue with the healthcare insurance sector is the rising expenses, and Centene's healthcare benefit ratio rose to 92.7% in the third quarter of 2025. Now, you might think that it's not a lot considering that last year it was 89%, but for a thin margin business, this is a huge amount, and it is exactly what cuts into their profitability. Now, looking ahead, Centene is focused on setting up marketplace plans for stronger margins in 2026. As the CEO explained that the third quarter was a critical period for this effort. They are rising rates to an average in the mid-30% range. Centene was able to reprice plans in states covering 95% of their current memberships. And for the remaining members, they took steps to limit margin impact. These rates are now officially approved, and unless policies change, open enrollment is set to move forward. So overall, in my opinion, this quarter was solid. Centene beat their earnings per share estimates and even raised their full-year guidance. More importantly, management seems to be taking smart steps to adjust to these temporary challenges. That said, it's time to dig a little deeper. Let's move into the financial analysis and see if there are any red flags hiding beneath the surface. So Centene is currently trading at $34.25, and it's far off its all-time high of over 94. We're currently trading at a negative price-to-earnings ratio. However, their forward PE is positive at 13.8, signaling that there is a potential turnaround in the near future. They have a fairly low return on invested capital of 6.7%, and their net debt to EBITDA ratio is 0.13, which is really low and a thing we really like to see, especially for a company that's currently struggling. Now, this is a graph of their revenue growth over the last 10 years, and it has pretty much quadrupled over that time, going all the way up to $147 billion. And while the growth is slowing for the past few years, it is still consistent. Now, this is a graph of their net income, and the growth here is even faster as they grew from $562 million in year 2016 all the way up to $3.3 billion last year. And it was growing consistently pretty much every year except for these two COVID years. Now, they have been issuing shares fairly aggressively until 2021. However, since 2021, they have repurchased more than 10% of their shares outstanding in just 3 years, which is another way of returning to shareholders. Now, this is what analysts are predicting for the company, and while they expect fairly large growth this year, they see Centene's revenue going flat for the 4 years after that. Now, this is a graph of analyst predictions for Centene's net income. And as you can see, analysts clearly predict struggles for the next few years, but stabilization by the year 2029. And looking at the earnings per share, the picture is pretty much the same. However, analysts do expect larger growth at the end of the 5 years, which is probably mostly caused by the share repurchase plan. So looking at Centene's financials, the picture is mixed but promising. The company is losing money right now, but analysts expect it to return to normal profitability over the next 5 years. On the bright side, Centene carries almost no debt and has been buying back shares aggressively, which is a positive for shareholders. On top of that, the revenue growth has been fairly stable, showing that the business is still moving forward. Now, with that context in mind, let's move on to my intrinsic value calculator. Alright, so let's type in their ticker symbol, which is CNC. Let's click Get Current Price, and let's do 2 calculations from the earnings perspective. One pessimistic and one base case. I will be using their earnings per share numbers for 2024 because their current numbers are already highly skewed due to the temporary issues. So last year, they did $6.31 in EPS. And according to analysts, that should grow to around $8 in 5 years. However, as I said, let's start with a pessimistic assumption, and let's say that their EPS will actually decrease by 5% each year for the 5 upcoming years. And let's say that for the 5 years after that, they will not grow at all and stay stable. Now let's give them a standard expected return of 10%, and for the terminal multiple, let's also keep it at a standard 15. Let's click Calculate, and as you can see, even with these pessimistic assumptions of shrinking earnings per share for the next 5 years and not growing them at all for the 5 years after that, Centene looks really undervalued, as its intrinsic value would be $60 when it's actually trading at $34. So let's try to find the actual return we could expect. Let's adjust it to 15. Click Calculate, still undervalued. How about 20? Actually, while it's red, if you look at the prices, the difference is only 3 cents. What does that mean? Even with these pessimistic assumptions, you could probably expect around 20% annualized return over the next decade. So let's be even more pessimistic and let's give them a minus 5% growth for the whole decade. Click Calculate, and let's try to find the value there. Let's try 17. And as you can see, even by shrinking their EPS by 5% over the next decade, the company could still return around 17% annualized returns. Well, I guess the terminal multiple is too high here then. So let's give them a 10. Click Calculate, adjust the numbers, 15, and you could still expect 15%. Okay, now let's do more of a base case. And let's say that for the next 5 years, their EPS will not shrink. And for the 5 years after that, they will grow at 5%. Let's adjust the terminal multiple back to 15 and click Calculate. Again, the company looks highly undervalued. So let's adjust the expected return to 25. And as you can see, the company looks pretty much fairly priced for a 25% annualized return over the next decade with these assumptions. And keep in mind, in my opinion, these assumptions are fairly realistic. So to sum everything up, Centene has definitely had a rough patch, and the recent Trump's proposal caused additional jitters. But nothing has happened yet, and the company is actively turning things around with repriced plans and margin improvements. On top of that, their financials look solid, low debt, stable revenue, and aggressive buybacks. And finally, after running my intrinsic value calculation, even under fairly pessimistic assumptions, Centene still looks positioned to deliver close to 20% annualized returns over the next decade, which is definitely not something easy to find. Now, what am I doing at today's price? I'm holding my position. I bought fairly heavily 3 months ago, and my position is already up over 20%. On top of that, I already own UnitedHealth and Molina Healthcare in my portfolio. And altogether, this sector makes up around 17% of my total portfolio. And honestly, I am comfortable with this allocation. However, if I didn't already own Centene, I would definitely consider starting a position now. That said, I'm not telling anyone to buy. These are just my thoughts. I encourage you to do your own research before doing any investments. Now, if you would like to dive deeper into this sector, I have just released 2 videos on Molina Healthcare and UnitedHealth Group. You should be able to see those 2 videos somewhere on the screen or in the description down below. Now, if you enjoyed this video, consider clicking the like and subscribe buttons. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.